Imagine a world where your Bitcoin, held safely for years, suddenly becomes unusable. Not because you lost your keys, but because the network itself decides your old addresses are obsolete. This isn't science fiction. It's a very real scenario called a quantum freeze being discussed in the Bitcoin community. And if it happens, it could trigger a massive, involuntary taxable event for millions of crypto holders. In this video, we're diving deep into the shocking tax implications of a forced Bitcoin migration. We'll explore whether moving your Bitcoin to a new address could be considered a taxable sale, if you can claim a loss on frozen coins, and why reconstructing your cost basis is more critical than ever. Stay tuned, because understanding these risks now could save you a fortune later. First, let's understand the problem. Early Bitcoin addresses, like P2PK and P2PKH, are theoretically vulnerable to future quantum computers. While the immediate danger is debated, the long-term risk is real. Developers are considering solutions, and one controversial idea is a forced migration. This isn't your typical hard fork that creates a new coin. Instead, it would likely be a soft fork with new consensus rules. Here's how it would work. A deadline would be set for all holders to move their funds from vulnerable addresses to new, quantum-resistant, or QR, addresses. After this deadline, the network protocol would simply stop recognizing transactions from the old addresses. Any coins left behind would be effectively frozen. This raises two critical tax questions. Is the mandatory migration itself a taxable event? And can you claim a loss on any coins that become permanently frozen? So, if a protocol change forces you to move your Bitcoin from one type of address to another, has a taxable event occurred? Under US tax law, the answer could very well be yes. The big question is this mandatory migration a sale or other disposition of property? IRC Section 1011 states that gain or loss is realized from the sale or other disposition of property. The term other disposition is incredibly broad. While you're not selling your Bitcoin for cash, the IRS could argue you're exchanging one form of property, Bitcoin secured by old cryptographic rules, for another, Bitcoin secured by new QR cryptographic rules. Think of it like a mandatory conversion of one class of company stock for another. Even if you end up with an asset of equal value, the exchange itself can be a taxable event. If the IRS applies this logic, every holder forced to migrate would have to calculate their capital gain or loss. This means the fair market value of your Bitcoin at the time of migration, minus your original cost basis. For early adopters, this could trigger substantial tax liabilities on long-held assets. Let's break down this sale or other disposition idea. The IRS has a history of interpreting these terms broadly. For example, if you exchange one cryptocurrency for another, that's a taxable event. If you use crypto to buy a coffee, that's also a taxable event. The key is whether there's a significant change in the nature of the property. In a forced migration, your Bitcoin is moving from one set of rules to another. The IRS might argue this is a fundamental enough change to count as a new asset. Let's say you bought one Bitcoin for $100 back in the day. If a quantum freeze happens when Bitcoin is at $100,000 and you migrate it, the IRS could see that as a disposition. You'd then owe capital gains tax on that $99,900 profit, even though you still have one Bitcoin. This is a huge concern for long-term holders with low-cost basis. To understand how the IRS might view this, we look to Revenue Ruling 2019-24-2. This ruling addresses hard forks and airdrops. It states that a taxpayer has ordinary income when they receive new cryptocurrency from a hard fork and have dominion and control over it. 3. This is based on the principle of an accession to wealth. How would this apply to a forced QR migration? The IRS could argue that receiving Bitcoin at a new QR address under different consensus rules is like receiving a new asset. The moment your new QR address is credited, you have an accession to wealth and dominion and control, triggering a tax event. However, taxpayers could counter that this is merely an upgrade, not a new asset. You still have Bitcoin, it's just in a more secure container. Unlike the Bitcoin Cash Fork 4, a QR migration isn't meant to create a competing chain or additional coins. The deciding factor would be whether the IRS considers the change in underlying protocol rules significant enough to create new property. Given the agency's cautious and literal interpretation, treating a forced migration as a disposition under Section 1001 is a distinct possibility. What about those who missed the migration deadline? If their Bitcoin becomes permanently inaccessible, can they claim a tax loss? Simply watching the value of an asset decline isn't enough to claim a loss. As the IRS clarified in a 2023 Memorandum 5, a loss must be evidenced by closed and completed transactions and fixed by an identifiable event. For frozen crypto, two types of losses under IRC Section 165 could potentially apply: a worthlessness deduction or an abandonment loss. Worthlessness is an extremely high bar to clear. An asset is only worthless if it has neither current liquidating value nor potential future value. In the case of frozen Bitcoin, the Bitcoin itself isn't worthless. The global market would still be trading it. Your asset is just inaccessible to you. Therefore, a worthlessness claim would almost certainly fail. IRC Section 165G, which applies to worthless securities, explicitly does not apply to cryptocurrency, as it's not considered a security under that section's definition. 6. So, if worthlessness is out, what about abandonment? This is a more plausible, though still challenging path. To claim an abandonment loss, you must prove two things. First, an intent to abandon the asset, and second, an affirmative act of abandonment. In a quantum-free scenario, the identifiable event fixing the loss would be the protocol deadline passing. Your failure to migrate could be interpreted as the affirmative act. This provides a much stronger basis for a loss claim than worthlessness. The amount of the loss would be your adjusted basis in the frozen coins at the time of abandonment. This is complex, and navigating these rules requires careful documentation and understanding. Tools like dTax can help you track your cost basis and prepare for these scenarios. dTax supports 22 blockchains, including Bitcoin, and 16 EVM chains, and offers 13 cost basis methods to help you calculate your gains or losses accurately. You can even use its pre-audit sandbox to scan for potential issues before filing. Check out getdtax.com. It's open source and free to start. For any of these scenarios, calculating gain on a migration or loss on a freeze, your cost basis is absolutely essential. And this is where things get really tricky, especially for early adopters. If you acquired Bitcoin before 2015, reconstructing your cost basis can be a nightmare. Records from defunct exchanges like Mt. Gox are gone, old hard drives are corrupted, and transaction histories are patchy. If you cannot substantiate your acquisition cost, the IRS can assert a cost basis of zero. In a forced migration taxable event, this would mean the entire fair market value of your Bitcoin at the time of the upgrade would be subject to capital gains tax. Imagine buying 10 Bitcoin for $100 each in 2010. If the IRS assumes a zero cost basis in 2026, and Bitcoin is $100,000, you're looking at $1 million capital gain, all taxable. To avoid this worst-case outcome, the IRS allows taxpayers to use a reasonable method to reconstruct their basis. This involves piecing together evidence from multiple sources: bank statements, credit card statements, and any old records you can find. It's a huge undertaking that requires meticulous detail. Navigating these complex crypto tax scenarios can feel overwhelming, but tools are available to help. dTax is designed to simplify this process. For instance, if a forced migration becomes a taxable event, dTax can help you track your cost basis across all your wallets and exchanges, even for Bitcoin. It supports 22 different blockchains and 13 cost basis methods, so you can choose the one that works best for your situation. The AI tax assistant can answer your specific questions about these complex scenarios, drawing from a knowledge base of 77 tax regulation articles. Plus, the pre-audit sandbox allows you to scan your transactions for potential IRS audit risks before you even file. This means you can proactively address issues like missing cost basis information. With dTax, you're not just tracking transactions, you're building a robust defense for your crypto taxes. Check out getdtax.com. It's open source and free to start. Let's answer a few common questions about this. First, is this quantum freeze definitely happening? While the quantum threat is real, a forced migration is still a speculative proposal, not a certainty. However, being prepared for potential tax implications is always smart. Second, what if I forgot my old Bitcoin wallet keys? If you miss the migration deadline because you lost your keys, it's generally not considered an abandonment for tax purposes. An abandonment requires an affirmative act and intent, not just negligence. Third, does this apply to other cryptocurrencies? The quantum threat primarily targets older cryptographic signatures, which are common in Bitcoin and some older altcoins. Newer cryptocurrencies and those with quantum-resistant updates might be less affected. However, the precedent for disposition and abandonment could apply to similar future protocol changes across any crypto asset. Always consult with a qualified tax professional for personalized advice, as tax laws are complex and constantly evolving. The world of cryptocurrency is constantly evolving, and so are its tax implications. A potential Bitcoin quantum freeze highlights just how complex and critical it is to stay informed and prepared. Whether it's tracking your cost basis, understanding potential taxable events, or preparing for unlikely but impactful scenarios, Proactive tax management is key. Don't wait until the IRS comes knocking. Keep learning, keep tracking, and keep your crypto taxes in order. If you found this video helpful, please give it a like, share it with your fellow crypto enthusiasts, and subscribe for more insights into the ever-changing world of crypto taxes. Thanks for watching, and we'll see you in the next one.